So now we're moving on to Chapter 9 on current liabilities. So the first thing we have to do is sort of locate ourselves. So far we've been working in the assets section of the balance sheet, and if we remember, you've got assets equal to liabilities plus the stockholders' equity. So we've kind of done a lot of assets, that's what you have. How did we get the assets? Well, you either owe money on them or you own them. Okay, so how does that work out? If you think of your car, maybe you have a $10,000 car, maybe you've got an $8,000 car loan. So the $8,000 is what you owe, and then you own $2,000 of that car. The finance company owns the rest. So right now we're going to be talking about the liabilities section of the balance sheet. And before we get to the current part of that, we have to know, well, what is a liability? So I'll take a couple of minutes on that. This is the formal FASB, Financial Accounting Standards Board's definition. So you've got a probable future sacrifice of economic benefits arising from present obligations of an entity to transfer assets or provide services to other entities in the future as a result of a past transaction or event. So probably the best thing to do is to sort of translate that so we all understand what we're talking about. Okay, so when you think of liabilities, you might think of accounts payable. Someone has sent your company a bill, you've got an invoice, you're going to pay it. That's pretty definite, but the definition says it can be probable. Okay, so it's not only ones we actually know about, but we could also, they're ones that might happen, and we're pretty sure they're going to happen. So when you throw the probable in, that leaves room for things like you've got a corner store, someone dropped a banana peel on your step, some customer comes and slips on it, and they're just going off in the ambulance. Okay, so you talk to your attorney, they say, yeah, chances are, it's probable that you're going to have to pay something on that in the future. Okay, so that event has happened, it wasn't a transaction. And there's going to be a probable future sacrifice of economic benefits. You don't know exactly how much, and it's arising from something that's happened, and you're probably going to have to transfer the assets. So if you think about these in sort of more concrete terms, sometimes it's helpful. So probable future sacrifice of economic benefits. What else do we need to say about this? So it can result from a regular business transaction. You buy supplies, you buy inventory, you pay your, you owe your employees money, you owe the government money. These are regular business transactions, or it can arise from the event. Okay, so usually you're going to pay this in cash. When they talk about transfer assets, usually you're going to write a check to pay a liability. But sometimes you owe people the services. So with my construction company, we would have people who would give us a check for, $50,000 and say, yeah, we'd like you to build us a house. So that's kind of the customer deposit. We take that, and we haven't done any work yet. We haven't, satisfied any performance obligation. So we can't call that revenue. That's a liability. So when we get a customer deposit, we would simply, we'd book the cash, and then we would do a customer deposit, which is a form of unearned revenue. And unearned revenue is a liability account. Because it's unearned, we can't book it as revenue. So we owe the customer the work. So when they say transfer assets or provide services, that means you may owe the customer some work and, not a check. Okay, so the definition covers a lot of ground here. Let's see, what else do we have to know about this? So the working definition, you can think of liabilities, obligations to other entities. We get something of value, we're going to have to, sacrifice something in the future as a result. Okay, so now this chapter is on current liabilities, the next one's on long-term liabilities. What makes a liability current? Well, it's going to be something that we reasonably are expecting to pay within a year or the operating cycle, whichever is longer. Operating cycle, if you're building suspension bridges or submarines or something large, could be more than 1 year. For our purposes, it's basically going to be, we're going to assume the accounting cycle is about a year. Okay, so within a year or the accounting cycle, whichever is longer, is the proper way to think about it, but basically it's going to be a year for our purposes. Okay, so we have to meet a couple of conditions to call something a current liability. The first is that what I just said is that we're going to pay it within a year of the operating cycle, whichever is longer. But also, we have to use up current assets in order to satisfy the obligation. So, what does that mean? That means that we're going to use cash, current cash, then we can call it a current liability. But if we had the same liability and we satisfied it by taking out a long-term note payable, we could not call that a current liability because we didn't use any current assets to satisfy it. So we have to expect to pay out of current assets like cash or providing services, or we're going to incur another current liability in order to satisfy this obligation. If we do anything long-term, if we issue stock or long-term bonds payable, long-term note payable, then we cannot classify that as a current liability. Okay, so why do they make a big deal out of that? Basically, when analysts are looking at a company, if you have more current liabilities, they're going to regard the company as having a bit more risk because those are coming due sooner and there's less leeway on paying them off. So things like the current ratio, which is current assets divided by your current liabilities, or the working capital, current assets minus current liabilities. If companies are looking to improve them, they're going to try to classify as much current stuff as long-term so that their numbers look better, and that's not okay. So that's why FASB has these rules, and that's why you have to learn the rules so you know what they are. Okay, so that's basically sort of the general definition of what's a liability, and then what makes a liability current.